Welcome to the Turnaround Podcast with your host, Stephen Phillips. In each episode, Stephen speaks to experienced practitioners who discuss their careers, key moments, challenges, and lessons learned in financial turnarounds and business restructuring. Join us as we unravel the secrets to turning struggling businesses into success stories. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frylibertas.com. Now, here's the host of the Turnaround Podcast, Stephen Phillips.
I'm delighted to welcome Matt Meehan to the Turnaround Podcast. Matt has recently launched Lyford Partners, a UK-based specialist credit provider focused on solving liquidity challenges for individuals, families, and businesses. Lyford provides tailored capital solutions of 2 million to 20 million to bridge short to medium term gaps in special situations. I first met Matt in the aftermath of the global financial crisis, and we've worked together on a number of complex lending and distressed opportunities. In 2021, for example, Matt and I worked together on the turnaround of Nextbase, the UK's leading dashcam technology company. He brings a sharp perspective on market cycles and a deep well of experience across jurisdictions and asset classes. I'm looking forward to hearing more about his new venture and the opportunities he's pursuing. With over 30 years in specialist finance, Matt has deployed more than $3 billion across 200 plus companies in the US, UK, and Europe. He joined us today to share his journey, the vision behind his new venture, Lyford, and his take on the evolving credit landscape. Matt, welcome to the Turnaround Podcast.
Thank you, Stephen. Thank you.
Well, thank you so much for joining us. I mean, I talked just a little bit about your career journey, but can you give us a little bit more specific detail on how you got to be sitting where you are now?
Okay, sure. It's actually started in 1981 when I read a book by an adjunct professor at Yale named Marty Whitman, who ended up being a iconic investor. He died approximately 4 years ago. The name of the book is The Aggressive Conservative Investor. And basically it means buy bank debt, get equity returns in distressed companies. So I worked for a firm at that time called Solomon Brothers. I went to Bob Solomon, my boss, and I said, I'd like to meet this guy. Long story short is we funded Marty in a number of transactions. And this was the beginning of the distressed credit market. And so this was the early 80s when David Rockefeller was raising what used to be called the prime rate every day. Paul Volcker was fighting inflation. And so there's a lot of turmoil in the corporate world. And back in those days, until Mr. Mike Milken came along and started trading bank debt, we would literally call the banks up. We'd kind of find out where they had things marked, offer them a penny more, and buy them. So we did a number of transactions behind Marty. Marty then went off and formed MJ Whitman and Company and acquired the Third Avenue funds. And when he died, he had sold the business to Mutual Shares, Michael Price, and was running 32 billion. And so it's an amazing success story. But those are the early days, and that's how we started off. It was, early 80s pioneers. It was time when also the original leverage buyouts were being done. Congolium, the first institutional buyout, was done in 79. And so it's the beginning of the LBO market and the beginning of the distress market.
Fantastic. And anyone who really wants to know about that market should read the book Barbarians at the Gates, which describes the takeover of RJR and Nabisco, and it was a brilliant book about the sort of the early development. And you also mentioned Michael Milken, of course, who was sort of the originator, one might say, of the junk bond market. So you're right in there. Very interesting time. Was
Yeah,
there
no,
any?
and one other thing, Stephen, to jump in here. So Michael
Yes.
Lewis wrote a book about Solomon Brothers during that period called Liar's Poker.
Oh,
And
yes.
I've got a little vignette in there when we went into the bathroom, and unfortunately, everything was full because of drug activities. So it was a far different world than the
Well,
button-down world of today.
maybe I don't know. But apart from those drug shenanigans, was there a sort of pivotal deal or moment that sort of made you think, right, I'm onto something here. I really quite like this market and what I'm doing.
Yeah, I think it was really when I started working with a guy named Ted Stolberg at a firm called Weiss Peck and Greer, and we would do what we called handyman specials, but what they really were buying kind of corporate assets that were kind of chucked out. And an example of that was Cape Cod potato chips. So Cape Cod potato chips was part of Eagle Snacks. Anheuser-Busch said, "Hey, we're going to take on Frito-Lay." They spent, I think, like $1.1 billion and failed. And as part of that, they shut down Eagle Snacks. Well, Cape Cod was part of that. We, with the founder, bought it and resuscitated it. And we bought for 3 million. We bought about 18 million of assets, including 13 million was spent on a water treatment facility, which is quite valuable in Cape Cod. So it was
Mm,
like, when people are throwing things away, what's there? How do we call them Humpty Dumpty deals because we also break them apart and we'll get rid of some parts but keep what we think is the good stuff.
mm.
Um, so that was and then we did a whole series of these in the 90s.
Yes, yeah, and well, I think when we met, you had started your own fund at that time. So maybe take us into sort of that kind of beginning of you sort of doing your own thing. How did that come around?
Well, I had done my own, actually did my own thing with backed by Yale, Harvard, and the Episcopal Church in the 90s. We used to
Hmm.
call it God in Yale. Uh,
Yeah,
and then for 10 years ran one of the larger distressed credit funds, New York, London,
yeah.
called EOS. And that's where you and I met.
Ah, yes,
And
that's right.
and
Yeah.
so EOS was about, again, it was a great period, early 2000s through 2012. Both pre and post GFC, we had the aftermath of the internet bubble.
Mm,
So we had the cable companies. We were the one of the lead in the restructuring of Eurotunnel, and so there's just a lot going on in Europe, UK and Europe during the time. The energy businesses, and so it was quite a great period. And then post GFC, there was a number of years, but then we got into this period of 14 years of zero interest rate policy,
mm.
which kind of took the breath out of the distressed credit market.
Yes, yeah. But you did set up your own thing for a few years, didn't you?
Yes,
Um,
yes.
yeah. So that was sort of in the 2010s type of
Yeah, yeah. So I
era.
had a
Yeah.
brief, yes, a thing called Me and Combs for a couple of years,
Yes. Yeah.
but we just didn't find the market that interesting at that point, and then moved on.
Yes. Yeah. Um, well, I think I've grilled you about the past. We did something in quite recently, but I wanted to talk to you about the future and the current, I should say. So, what inspired you and your partner Toby Bundy to launch Lyford Partners?
Okay, well, we saw an opportunity in both. We have kind of two businesses. One is we fund insolvencies, liquidations, and receiverships,
Hmm.
UK, Ireland, Channel Islands, Cayman, BVI, and that's one business that is quite interesting. And it's basically, we've pioneered what is called dip financing in the US into the UK and these offshore jurisdictions. So that's
Yeah.
one thing. And then the
So
other,
I should just in case people who don't understand what DIP is, it's debtor in possession, and it's a US concept, but you can sort of repurpose that concept and lend to insolvency practitioners,
correct.
essentially.
And often they use it in place of litigation finance. So
Yeah.
if there's collateral in the estate, we can lend in the mid-teens
Mm.
versus going to, and we can be very flexible and relatively quick versus a lit funder who they have to take time because we really don't care about the law in essence. We just, as long as there's collateral, that's all we care about. And so we can act quicker. We don't take 2 to 3 times MOIC or money return, or we don't take 30% of proceeds. So if there's collateral in the estate, the receiver, liquidator, administrator can then move quickly and at a much cheaper and more beneficial outcome for the stakeholders. And
Yeah, and
often our
yeah,
money, this money, Stephen, is used to go for frauds or go for legal action.
yes, yes. So I heard you say we don't care about the law, which I'm sure is not what you meant. What I'm sure you meant is you don't
No
care necessarily about uh,
outcome.
the order of priorities, etc., and the outcome to the estate, because your focus is on the collateral,
Correct.
and therefore you'll get your return. As long as you've got sort of some kind of collateral support in
Yeah.
your credit.
And
Got
then
it.
the
Yeah.
other opportunity we've seen is that the private banks, the Swiss banks, some of the UK private banks have pulled back from the what I call the asset-rich cash poor, or what we colloquially call it's a pawnbroking business. These are lends of 5, 10, 15, 20 million to wealthy individuals, ultra high net worths, families, family offices, where they either have they want to buy something but don't have the liquidity to buy it, or
Mm,
they have some liquidity or challenges that we can help resolve. And
mm,
tied into that is inheritance funding, probate funding. So as you know, that there's disputes in probate. The probate courts are backlogged, and so we can give advances to both probate and inheritance. And then finally, the other thing that ties in with the families and is we do matrimonial law,
mm.
matrimonial funding. And so, which is quite a good market. In London, as you may or may not know, is the divorce capital of the world. So people, there are divorce tourists that come to London.
Yes, yes. I'm aware of that. I've got a divorce barrister who lives very close to me, so I do
Okay.
hear about the cases in general. But perhaps you can explain that. Why would somebody in the middle of a divorce need a loan?
I can give you a couple examples. We
Mm,
did one where um, the husband had unfortunately run afoul of the law. He had settled that, and his wife had assets that were worth, call it 10 to 12 million, at least in her mind. And we were able to lend her 2 to 3 million to then settle the estate with him because he needed the cash. So
mm,
it worked out for him and it worked out for her.
right.
And so
Mm,
it's that kind of thing where we can assist and provide a solution for settlements.
got it.
Um,
Yeah. And then on going back to the liquidator and administrator type stuff, what kind of cases are there? They're kind of transaction that undervalue, preferences, fraud. Is that?
Examples will be we funded two insolvency practitioners firm in a 250 million fraud.
Yeah.
There are over 100 million of assets. We lent 20 plus million and allowed them to go after the audit and egg claims. It allowed them to pursue the bad guys
Hmm.
and allowed them to have time to realize better value in the sale of assets. So
Yes.
and so it's often has components of all three, or it could be the administrator for wants to trade the admin, so trade through the admin,
Yeah.
and we've got a term sheet out on one now where to do a fire sale makes no sense for any of the stakeholders.
Hmm.
There's no lender involved in this one, so it's all unencumbered assets. So
Yes.
it allows again us to allow the administrator to really maximize value for the stakeholders, and that's really what this is all about.
Yeah. I'm sort of looking at a situation right now where there's the company is sort of looking at the end of a runway in terms of its cash burn, but it probably needs to sell itself quickly. I guess this might be a situation where you might be able to fund to allow it to get to
Yeah,
the transaction.
if we can put money in and provide a bridge, but we need to
Yeah,
be super senior, top of the stack,
yeah,
that and there has to be fallback collateral. We'll do
yeah,
that, and we can do it relatively quickly and flexibly.
yeah.
And that's
I
a way
mean,
to preserve jobs, preserve a business.
I think one of the tough things about businesses, how they operate nowadays, is so many of them are very asset light. They don't have real estate and factories and cars and all as a business would have done 50 years ago. Do you sort of accept that collateral might be over intellectual property or something like that?
Yeah,
Or yeah,
we have lent on the IP, but it's very difficult. I mean, I can give you numerous examples of companies that were worth 8, 10 billion at
yeah,
one time, and they need 5 million, and we couldn't do it.
it's incredible, isn't it?
Yeah,
It's just that's the sort of the model that many businesses are, where they're basically a kind of bunch of contracts. And when you sort of look under the bonnet, there's not much that you can
no.
attach as a
So
secure
those
party.
businesses usually get wound up to trade or liquidated with the IP just being sold.
Yes. Yeah. Yeah. Yes. Okay. Well, hopefully that doesn't happen to a situation I'm looking at.
Okay.
Um, so you've given us some examples, which are great. What's your ambition for life over the next sort of 3 to 5 years?
Well, we think there's more opportunities both geographically,
Mm,
and there are some other niche markets that we've explored that again really revolve around the private wealth, the family issues
yes.
area, less corporate, and
Yeah.
so it'd be both geographic and a little bit of expansion about some other niche areas. Uh,
Yes. Yeah. And geographically, where are you thinking?
it would, ultimately, and it wouldn't be this year, it's probably not next year, but it'd be the US
Hmm.
and
Okay.
Canada. Um,
Yeah. Yeah. Okay.
because right now we're doing UK, Europe,
Mm.
and we've contemplated also opening up an office in Europe itself. But right now it's crawl before you walk, before you run.
Yes.
And
Yeah.
but having said that, we've closed 2 deals. We're about to close 3 others, so we've been extremely busy.
Yeah. Yeah. Well, maybe tell us about the first couple of deals.
So one was for ultra high net worth in Spain,
Mm.
and it allowed him to restructure a real estate portfolio and take advantage of buying a property that at quite an advantageous purchase price, but we
Hmm.
had to move relatively quickly. It had some, often they look complex from the get-go, but by the time we finished, we've very much simplified it. And that was
Yeah.
what this was all about. I talked earlier about the Humpty Dumpty deals, breaking the egg apart doing different pieces. This has had very much similarities to that. Another one is in France, and it revolves around some kind of unique real estate properties where again, this ultra high net worth has an ability to buy them at an attractive rate, but there are some complexities from the get-go that we simplify. Um, Another one is in Italy. It's a football club where the Italian FA requires um, the owners of the football clubs to put up capital. The owner of this particular club, for tax and other reasons, doesn't want to put that up himself, so we funded it, we're funding it, and it allows, and these are not against Italian assets, but these are against assets in a jurisdiction that we think is more, it's UK-like.
Okay.
Let's just put it that way.
That's interesting.
Yeah, so it's just where, people get themselves in a spot where they need a 12 to 18-month holistic solution, and these deals are deals that fall between the cracks. And it's not right for a clearing bank. It's not right for a direct lender. It's too small for the funds. So the market we live in is kind of 2 to 12 million. We can do 20, and we're doing one, but it's really, these smaller situations that again appear complex, but can be relatively quickly, as long as there's collateral. We can solve the problem. And one thing that occurs over and over is Mark Twain said, "Things don't repeat, they rhyme." And so let's just say we see the same things over and over again.
Yes.
And part of our job with the high net worths and the people is just, we tell the truth. We say, here's what we think and here's why. And we also say, go out and talk to other people. And we're here. And it's kind of, life is too short.
Yeah, no, I get exactly what you're saying, which is that probably a lot of the retail banks, or even the sort of the bespoke private banks, like simple opportunities, a clear story, not a hint of distress, etc. And you're involved in something a little bit messy, but you're able to sort of look at the situation very clearly and think, are there assets here to attach or to protect my downside?
Honestly, probably 30-40% of our referrals come from the private banks, the Swiss banks, Monaco, UK, Cayman. So it's there are we work with them because we're a trusted pair of hands, reputationally and conduct wise. So we can tick that box.
Yes.
And understand the world they live in and the world their counterparties are involved.
Is it the case that sometimes the private banks don't want to say no to their clients, but at the same time they don't want to do the deal, so they try and find a solution?
Yeah, we're a solution, and we're not a threat to the private bank's wealth management or the private bank's ongoing relationship with the client. We're a service. We're just like one of their service providers.
Yeah, got it. And you mentioned you can do up to 20, which sounds quite a lot of money. So where did you get the money from? I mean,
we are backed. We are super fortunate to hook up with a group called Lyford Partners, which was started by two billionaires in the 80s. I didn't even know there were billionaires in the 80s in Boston. And what Moody Aldrich does is it funds alternative managers. And I think we're number 12 over a 30-year period. And their track record is extraordinary. And there's a culture fit, there's a risk fit. And so they've provided us working capital, seed money, and we're in the process of going out and raising a fund now. In the meantime, we've secured $150 million from a London-based credit fund whose principals I've known for a long time. We're publicly going to announce that in a few weeks.
Okay.
But that's in motion right now while we raise the fund. So we've got seed money, working capital, sponsorship, and then we've got long time relationships.
Yes.
I've been doing this in the UK market since the early 2000s. So as you
Yeah.
mentioned,
Yeah.
it's kind of circle the hat with the friends.
Yes. Yeah. No. It sounds like a great setup. So I wanted to sort of pull out a little bit away from your fund and your immediate opportunity, but I wanted to understand how you saw the current investment climate, particularly for credit.
Okay. Everybody's afraid of the bubble, and candidly, I've been calling it subprime 2.0 for the last 4 years, and I've been wrong.
Yes.
In fact, I've told people I'm not allowed to talk about it anymore.
Yeah.
But having said that, I've thought a lot about this because we do see you really, they talk about the K economy. There's really a K function in private credit. Okay. And let's put aside, because I do believe this, that the first brands and the tricolors aren't canaries in the coal mine. And you're gonna see those. But we've got the function of private credit. So you've got a lot of funds and these are primarily the middle market and smaller funds in my mind that are more sales machines and marketing machines than credit machines. Often
Yeah.
they don't have workout departments. They don't
Yeah.
have that kind of skill. And if you dig deep and look at how their compensation works, and I always look at, follow the money.
Yeah.
And if they have one bad deal, the economics fall apart for the principals.
Mm.
And so I've often, that's a bad business model. And so I think they will they will be the people who face issues. Will Apollo or Ares or some of these real big guys, I think they're more geared to have the resource to work their way through things.
Mm.
And doesn't mean there won't be problems, and doesn't mean there won't be credit cyclicality. But I
Mm.
think the real opportunity for the distressed investors, which we're not, um, is in the small to medium sized credit funds, where they
Yes.
just don't have the resources. And then the question also is they mark to model.
Mm.
There's been a lot of publicity in the last 3-4 weeks around some of them use rating agencies or third parties that aren't S&P and Moody's or
Mm.
Fitch. And question mark, don't know, but we'll see. And I think the
Mm.
same thing applies to private equity. There's an interesting statistic that in the last 7 years, less than 30% of the private equity funds have raised new capital. And we
Yeah.
all know about these continuation vehicles and the continuation vehicles I've now seen. And that music at some point will stop.
Mm.
And can these other funds end up raising money, or is it game over except for the big players who can move into whether it's sports, which is people have been talking about for the last few years, and is still ongoing play, or one that I do have some questions around, which is all the private equity that's gone into accounting firms, law firms. Does that really make sense? I don't know. I question it. Um, but
Mm.
the thing that investors have to be thinking about is, who's going to survive? Is it the man in the middle, or is it the big guy and then the nichey, more nimble, more hyper focused, uh, smaller player?
Yes.
And so I would think there's going to be a shakeout in private equity, just like we're going to see the shakeout in private credit, but it's not going to be this big, I think you mentioned the word bubble. I don't see it as a bubble.
Mm.
So put me in the Mark Rowan camp
Mm.
in this debate. I'd love to, hear your thoughts, but I just, it's
Well,
still
it's
got a,
become. I think certainly on private credit, it's become a bit of one could call it a trope. A number of these private credit companies have issued obviously a lot of loans. There's been a lot of money sloshing around. Um, the question is how much leverage they have taken on in order to issue those loans, and whether if one or two of those loans in a portfolio go wrong, is that going to trigger the kind of sort of situation that you saw back in '08? In other words, a mass selling event, a decline in the value of the loans, and will the people who provided leverage start enforcing on the security if their collateral
Okay,
call?
well, you're on to something there,
Yeah.
and this is something that someone somewhere should do a lot of work on. Is,
Mm,
people talk about the circularity in AI, in the
mm,
AI investments.
hmm.
There's take that circularity and multiply it by 100 or 10 or pick a number, because you're seeing the clearing banks fund the private credit guys with leverage. You're seeing private credit guys fund other private credit guys. You're seeing the NAV loans. You're seeing the wholesale funders fund the private credit guys. You're seeing other people funding the wholesale funders funding each other. I mean, it is, and you're seeing this in the ABL market. You're seeing this in primarily in the middle market, but it's really interesting. And that's where when the music stops,
Mm.
and and people look under the hood, and no one's really done enough work here. To me, that's
Well,
that.
I'm not sure how much work you can do, because I think
It's a pretty opaque.
the $1 million question is how much leverage is there for companies providing private credit loans, etc. Is
Yeah,
Are they
but
levered up a lot, or
it's leverage on leverage, and
yeah?
it's all kinds of, it's ABLs doing ABLs, it's the clearers doing
Mm.
the private credit, it's some private credit doing other private credit, and again the circularity, because we've seen this, because
Yes.
when we look at situations, it's sometimes it's the crowdfunders on the smaller ones, sometimes, and it's these multiple layers and multiple fundings that will come unglued. I mean,
Mm.
one thing that really happened in '08 was people didn't know what they owned,
Yes.
and people did, and here people don't know really who's their underlying funder, because it may be second or third derivative
Mm.
uh, funding,
Mm.
and so the investment banks are involved in this. So it's
Mm.
everybody's got a finger in there.
Yeah. Well,
And the
I
question really,
guess.
Stephen, is what, like with Bear Stearns, then Lehman or whatever, what's going to
Yeah.
trigger this?
Yeah.
And that's the $1 million question, or billion dollar question, or $1 trillion question. I don't know.
Well, I think there's a little pushback I can see, or difference between '08 and now, which is that in '08 you'd have a fund, and I acted, for example, for Basis, which was one of the big Australian funds that had got exposure to CDO squares and all those kind of very esoteric instruments, as well as high yield. And they had their collateral that they had bought essentially within the banks. And then when there was a downshift in the market, and there was a requirement to post more collateral when you're the fund, and your broker says, right, post more collateral because the prices are going down, then the brokers essentially could do their enforcement very easily, because you basically hold your collateral with the brokers, and they send you a notice saying I want more, and you say, well, I can't quite pay, and they just enforce, and suddenly there's this massive fire sale of public securities out in the market. This is what we saw in '08. And then everyone suddenly thought, well, I don't quite know what these securities are. What is a CDO square? What is
Yeah,
this?
what do I own?
Um,
And when it's all started with margin calls, and
exactly. But I
I
think,
just sorry,
yeah,
go ahead.
so just to finish my thought, it's very difficult to see the same dynamic unfolding in a private credit fund, because essentially you don't take security over the loans themselves. In fact, it's very difficult to transfer those loans. So what you might have is security over the fund itself, possibly, and you might be able to sort of enforce on the whole thing. But it's a very different dynamic to the sort of the easier kind of enforcement process that we saw in '08. So that's my one sort of pushback to this
Yeah, the question,
explosion.
your question is how do they get, now they do take leverage, and the question is it would start in another market and be contagion
Mm,
into the private credit market, and
yeah.
would be contagion to the underlying portfolio companies that they've lent to, or
Mm,
companies they've lent to, and we'd have, even though these are often unitranche, cov light, they would
yeah.
still bust through. There'd be technical defaults.
Mm,
Um, and it's
mm,
always the margin call. So I just finished reading Andrew Ross Sorkin's 1929, which I
yeah.
recommend to everyone. And that's
Mm,
about the massive 08-ish spread of speculative investments by individuals in the US and institutions in the US. And really reminiscent of '08, really reminiscent of some things going on now.
yeah.
Um, and yeah, again, what just makes me step back is we've had this period of zero interest rates for 14 years.
Mm,
And, we've now had rates go back up. What's real inflation? And, I just think you can't have a calm for so long. You can't have the largesse of COVID
mm,
without something coming home to roost.
yes.
But
Yeah.
again, that may be 3 or 4 years from now, but
Yeah.
it will happen.
Yes.
I don't think, people always ask me, are we in, the AI bubble stuff that's been, if we see another article, we'll want to get sick. But I'm not sure when, I've been doing this for a long time.
Mm,
And when people talk about a bubble, it's usually not a bubble.
mm,
When they're not talking about the bubble, then it's a bubble. And so, if the Fed's truly cutting rates, central banks are cutting rates. If you look at stock markets and bond markets, the last 21 times rates have been cut. Both the
mm,
stock market, with two exceptions in recent history, last 40, 50 years, the stock market's actually gone up.
yes.
And and while valuations certainly are stretched, I mean, if the average PE ratio historically is 16, 18, whatever, I'm not a stock market guy, and it's
Mm.
now 24, 26, we're not seeing anywhere near that what we happened in the dot-com bubble in terms
Well,
of 20 times or 30 times revenue or more.
yeah. I mean, I actually think that we've seen, you might call it the great bifurcation, which is a massive concentration in the
Yes.
Magnificent Seven, where obviously some of the PE ratios are absolutely nuts. If you look at Tesla, in my humble opinion, but at the same time, if you look at most somewhat disregarded firms that have perfectly good businesses, they're not trading at ridiculous multiples. And in fact, if you look at certain markets, very unfashionable markets, the UK probably being the most unfashionable market, there are incredible opportunities. The emerging markets, haven't been invested in for years. So I
Yeah, this
think
is
that,
another one of the Ks. This is another K.
yes,
We're living in a world of K. We can point out the haves and
mm,
have-nots.
yes,
I mean,
yeah,
let's take each slice of the economy or the stock markets or the bond markets, and it's quite interesting. So I
mm,
don't see the panic yet.
yes,
Um,
yeah.
but
Well, the famous last words,
I
but
know.
yeah, but I think particularly as you say, if there's going to be a bit of a reduction in interest rates, um, probably there's going to be that excess liquidity, as it were, is going to find its way somewhere. And I do think people are now nervous a bit of the of
No, no.
what
Again, I think it's going to be the
circular
K.
economy.
I think certain sectors in
Mm,
private equity, certain sectors in credit are going to get hit hard.
Yeah.
But in the bigger scheme of things, it's a tale of two cities.
Yeah. 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 Well, we will see. I wanted to also ask you a completely different question, but it's are you now seeing technology changing the way you operate as a fund? I mean, you've been doing this a long time. Now
Absolutely.
seeing this change a lot.
Absolutely. I mean, we hired a young woman who had worked for TikTok in Beijing, or ByteDance, however you pronounce it,
Mm,
in the AI department. And her job for us is re-engineer. What I don't want to do is walk backwards into the future.
yeah.
And so I wonder if we need to change our model about how we approach things. Now, clearly, there are all kinds of ways the obvious things of AI for legal, for financial documents, for even modeling. I mean, it's really cool. So
Yeah.
we're trying to rethink the functions of what is how functionally, and not and we're not hierarchical, so we're fairly flat. But where do we spend our time? How do we spend our time? And how can we automate? And how
Mm,
can we be more efficient?
yeah.
And let's try. It's very difficult to get rid of preconceived biases and
Mm,
preconceived thoughts around how a business should be organized. But is the C-suite 5 years now can be the same as it was 20 years ago?
mm,
And so I was with the president of the University of the Bahamas yesterday, and he was talking about how do they reorganize the whole form of education. And obviously, this has been talked about for a little while, but
mm,
again, because the way kids get information, ingest information, people complain about reading, writing, whatever,
yeah.
and rethinking their model because they
Mm,
have to. And
yes.
I think I've got to believe, the corporate world's doing this. We're all doing the same thing.
Yeah.
And I don't have any, silver bullet, but but to answer your questions, nothing is not for sale or nothing can't be changed in our
Yes.
organization.
Yeah. I definitely see massive changes happening. Even it's not about the future; it's about happening now. Where I was just on the line to my personal solicitor to do something, and he sent me this sort of set of notes that had obviously been generated by AI that perhaps a junior would have done recently. And I see it for professional services as a real force multiplier. I'm doing a lot more, a lot quicker to a higher standard. Um, but the real question is, what about juniors? That's the hardest thing
Yeah,
because
or even a
yeah,
bigger thing, and a thing that I'm focused on is tokenization. So
mm,
using blockchain, tokenizing insurance, tokenizing security,
yeah,
tokenizing, you name it. And so that's also part of the charge is, and I'm not
mm,
saying it's like, how are the courts going to react to this if we
mm,
can, tokenize our fixed charge, our debenture, whatever,
mm,
or our security interests, and you can certainly tokenize insurance. So it's going to bypass certain middlemen. It's going to challenge the courts because often you wonder, do you even need the court to act? Can you just
mm.
act by taking the token? And
Yes,
so blockchain and tokenization, I don't think we've all thought through in terms of applying it in every sector.
mm,
And it's going to be revolutionary, and it's going to affect our business.
yes.
So
So
I'm,
you mean with the tokenization? I presume what you're really saying is if you need to enforce, if you've got hold of the relevant key, you can just sort of
bingo.
take the asset without going
Yeah.
to.
So in the US, there are 25 states you can do this in. We're doing a research project
Mm,
with a London law firm
mm,
to think about how do we do this in the UK.
mm,
And then also have discussions with government. And because, they want to make things, they've obviously spent a lot of money and had a lot of thought around this. So we're doing a little bit of a science project in the UK.
Fantastic.
So, yeah, no, it's very cool. Well, it
Yeah.
may not lead to anything, but
Yes.
we
Yeah.
want to, tokenization's high on our list of things to think about.
Fantastic. Well, look, I've taken up 45 minutes of your time, which is just, it's been fascinating. I think we've sort of pretty much covered, a
Too
lot of
much.
stuff. And I'm sure if anyone is interested, they'll get in touch with you or me, and I'll,
Great.
I think that's generated a lot of interesting thoughts. So thank you for
Thank you, Stephen, for your time.
for coming on, and good luck with the new venture.
Okay, great. Thank you.
You've been tuning in to the Turnaround podcast with your host, Stephen Phillips. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frylibertas.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.